Brooklyn, the goal of a retiree needs to be to outperform, like hopefully to grow more than the cost of those real world consumption, that real world consumption that they're going to want to do in their retirement. So looking at the next 10 years, how do you think about tackling that challenge of growing more than that benchmark?
Yeah, it's a good question. And I have the benefit of having families in both the US and Egypt. I have homes in both countries. And so people in Egypt, when they're tackling this question, they're tackling it in the context of 20% annual, just the year after year money supply growth, right? And so obviously they can't be like, well, as long as I have enough Egyptian pounds, I'm good, right? They have to think, how many dollar equivalents or energy equivalents or gold equivalents do I have, or how many real estate equivalents do I have in terms of what I'm saving, right? So the worse your currency environment is, with the extreme end being like Venezuela or Lebanon or Argentina, and to middle extent being like Egypt or Argentina, and then to the benign extent, relatively speaking, being Europe, Japan, or the United States, you have to think, okay, there's a certain unit bias here.
Yeah.
And so, you know, in the US, money supply goes up by 7% a year on average. Obviously, it's been a bit weird in recent years, but over the long arc of time, it's been about 7%. And some of the more energy or labor intensive prices we have, so hospital services, oil, gold, housing, right? Those type of things are closer to, maybe not money supply, but like money supply per capita, right?
Yeah.
So if money supply is 7% per year, money supply per capita might be 6%, might be 5.5%, depending. And so that's kind of your benchmark for like high-end resource intensive services. And then of course you hopefully benefit from technology. So when technology gets better, so processing gets better, offshoring gets better, we make a tire and shoes more cheaply than before. All of that tends to go down and help lower our average cost basis. But when we kind of like picture the American dream basket, so single family home, good healthcare, education for our children, um, that kind of, like just that kind of stuff, that's towards the higher end between, say, CPI and money supply growth per capita. We basically don't want to get diluted in our share. And so we have to think more in not just in nominal terms, but in those purchasing power terms. And we've had in the United States, we have the benefit of a 40-year bond bull market, so interest rates ever lower, equity valuations ever higher. When we think more globally, most equity markets don't go straight up and to the right, right? So Europe equity markets like literally like flat in dollar terms for like 20 years. Japan flat in dollar terms or even yen terms for like 30 years. Emerging markets often flat in dollar terms for 15 years or more. So in most, let's say 5 or 6 billion people in the world, equities are not really cutting it. It's the U.S. has kind of been the exception there, and we've had to basically just constantly drop interest rates and constantly boost equity valuations in order to achieve those very high results. And so if we say, okay, we're maybe let's just say we're maybe not going to repeat that for the next 30, 40 years.
30, 40.
Right. So if that's the case, if we can't rely on the best ever equity market in the world continuing to do what it's done, or that whatever equity market we're in, if we can't assume it's going to be like a top decile outperformer, what else can we do? And historically, a
Historically,
historically a balanced portfolio gives us better risk adjusted returns. So it's like equity, real estate, whatever money is at the time. It could be gold, it could be fiat, it could be short-term bonds, could be tips, whatever money like instruments. Obviously, in the modern environment, that could be Bitcoin. And one of the better hedges is commodities or commodity producers, because generally you go through a period of roughly 2 decades of commodities doing poorly, disinflationary growth-oriented stocks doing great, and then usually a decade or so of the opposite. So growth-oriented stocks being overvalued and getting killed, and all of those commodities and commodity producers going up like 5x, right? And so having some distribution among these various types of often non-conforming asset classes is a good way to ensure the probability that you can rather gradually grow your real purchasing power into retirement.